Hello and welcome to Indianomics. Our spotlight today is on steel. India's banking system's fortunes are closely tied to steel, and the domestic steel industry's fortunes are tied to the global growth cycle. Since December, there has been a huge upsurge in the prices of both steel and its raw materials. Chinese steel prices have shot up by 48% since December, and European prices by 23%. Raw materials, iron ore, has shot up by 45% since December. At home, steel prices have surged by a more modest 15% in the last couple of months. While the Indian government has sought to protect domestic steel by imposing a minimum import price of $440 per ton since February, landed prices are anyways ruling higher currently. Simultaneously, pressured by the Reserve Bank, banks have been arm twisting steel companies to shape up or ship out, which itself is driving cost efficiencies. So, is the worst over for Indian steel and hence for Indian banks to some extent? Well, to answer those questions, I have with me a star panel: Mr Seshagiri Rao, Group CFO, JSW Steel; Neelkanth Mishra, India Equity Strategist at Credit Suisse and adjudged best in class by several bodies like Asia Money; Krishnan Sitaraman, Senior Director Ratings at CRISIL Limited; and in a bit we will be joined by Kevin Bai, the Beijing analyst of the commodities think tank Crew Group. Gentlemen, welcome. Let me start with you, Mr. Rao. We have seen this 45% upsurge in landed steel prices, especially from China, from say $250 in December to what, $450 today? Can prices stabilize at current levels for the rest of 2016, or will we see a correction?
No, as far as the steel sector is concerned, the outlook which has been given for the year 2016 by World Steel Association is a lower demand by 0.8%. The total steel demand for this year is estimated to be 1488 million as against 1500 million tons of for the year 2015. So there will be a lower steel demand, that is the projection for FY 2016 by 12 million ton over 2015. So that is the outlook as far as the steel demand is concerned. Then what has happened in the last few weeks is that sudden increase in steel prices and at the same time increase in production by the Chinese steel companies. But the price at which the steel was sold in the calendar year, January and February, they were unfair prices, they were not sustainable prices, so steel prices had to go up. But the steep rise in prices which has happened over $200 per ton in the last few weeks, I think it is quite steeper, but the demand-supply dynamics will not justify the kind of pricing which we have seen. But some stability in the prices would have to come in. So some correction to the downside may happen from the current levels. Okay, but what is your sense of the downside? Say take an average flat steel products. What are they selling at now? $450. How much do you think they may dip to? Can they dip even below $400? No, in my view, it should be above $400. But the pricing which has happened close to 500, which is there in the international markets, that too has happened at a faster pace. This is driven majorly by Chinese production and also the increase in the market prices in the China. That has driven the prices really. But the actual demand side, I don't think there is a perceptible change in the overall demand outlook across the world. Okay. So taking that into account, I think the prices at the current level is not sustainable, particularly the demand outlook which has been given by the World Steel Association.
Okay. Let me come to Neelkanth on the same issue. Neelkanth, your company has actually gone from underweight on materials to actually buying or recommending buys in some of the materials companies. What's your outlook on steel prices?
For once, I think in many years, I think I'm more bullish than Mr. Rao on the prospects for the steel industry. See what happens when you see a very steady decline in prices. So for the last 2 years, steel prices have been falling. If you are anywhere in the steel value chain, whether you're a steel producer, you're a steel distributor, you're a steel, say a truck company which uses steel, there is no incentive for you to hold inventory. So you pare down inventory to the minimum possible. Inventories have gone down to very low levels after a 2-year down stock. Now, what starts to happen, and so what has happened is that the DXY, the trade weighted dollar, because of the Fed's remarks that the rates won't go up as much as expected.
Yep.
So because of that, there has been a spike in the currencies of countries that produce raw materials for steel.
Yep.
So the Brazilian real, the Aussie dollar, the Canadian dollar, the South African rand, they've all bounced back. So now there is a floor drawn on steel prices. Now, what that starts to do is that immediately, if you're a steel buyer and you realize that, oh my God, so now the steel prices could actually start going up, you start demanding more steel. And throughout the value chain, and this is a supply chain, in supply chain theory, this is called the bullwhip effect. So what happens is, you even for a small volatility in end demand, so your car demand volumes may not go up very much, but the steel producer will see a massive move up in steel demand. So the decline that we had seen was a destock effect. The upturn that we are seeing is also a restock effect, and the viciousness of the restock. I don't know if you have seen, so Mittal has now raised prices by almost 40 euros in Europe. Iron ore prices have gone up to $70. So, so I think the base case for everyone is 45. Iron ore is in such shortage that it's gone to 70. So now the cost curve is viciously moving up, and we think that the supply chain in steel cannot respond fast enough. So, on a 1,500 million ton, 1.5 billion ton demand, if demand goes up by 2%, you're talking about a 30 million ton additional demand, which means 50 million tons of additional iron ore. That's a lot of material. You need to charter ships, you need to start the railway lines, and so on and so forth. And if you saw the output numbers updated by Vale, Rio, and BHP, the guidance for this year's output was actually brought down. So it is very likely that the restock can last for several quarters.
Well, that point is taken, Neelkanth, but is it not likely that precisely this up move in prices will bring mothballed capacities into the market?
So two things here. The first is that this restock is actually a global event. So inventories, I mean, if you see the apparent demand growth in Brazil, in Russia, I mean, the apparent demand growth was minus 25% year on year for many months in these markets. And so clearly there is, I mean, the demand surge will be actually global. It's not just about China. The supply response is actually going to be muted. So there are two reasons for that. One is that the steel companies themselves are actually quite suspicious, given the kind of stress and pain they've gone through in the last 2 years, of the sustainability of this rebound, and therefore they will be reluctant to start furnaces which is going to get over in 2 months. Secondly, banks are very reluctant to give working capital to some of these companies because they realize this is throwing good money after bad. And in particular in China, I think the restart of some of the furnaces could actually take longer, and which is why this restock can last for long enough for investors to take advantage of it. And I must clarify that this is a restock rally. The structural concerns on steel that China cannot keep consuming that much per capita, those still exist. What has also happened, and this is an important point as well, that China on a strategic level seems to be moving away from the supply controls and back to demand stimulation. And while so far it has only been visible in the credit growth numbers, our analysts, China analysts, believe that there have been a surge in project approvals, and that will drive a surge in metals demand in the second half of this calendar year, possibly into 2017 as well, as those projects hit the ground. So, which is why the steel traders in China, so as the credit availability has improved slightly, they have started stocking up on steel in anticipation of the demand surge. And suddenly everyone wants iron ore and no one is getting it, and that is why iron ore is at 70.
Okay.
And this can actually last for several quarters, so it won't get over in a few months.
Do you think that a movement like this in terms of positivity of margins can lead to better M&A activities so that weak companies move on into strong hands?
I certainly hope so. See, I think, and so that is where it is important that I keep highlighting that this is a tactical move. This is a restocking move. This is not demand structurally coming back, and that we are suddenly very positive on steel on a 5-year basis. We are not, right? So this is a restocking move, and it is very important that companies with weak balance sheets use this opportunity to repair themselves. When someone goes and does a rights issue, someone goes and raises equity, someone does M&A, sells off the assets. So it is very important that these activities happen, so that when the restock ends and steel prices start coming down again, that the balance sheets are in much healthier position than they are right now.
Okay. You expect M&A activity in India? Are you confident from what you are picking up as straws in the wind?
It is going to be much more difficult in India. It is, I think, quite more likely outside, where there is a lot of, I think, history of mergers and acquisitions. I think there is a lot of stigma about selling assets in India. I mean, a lot of promoter groups think it will bring shame on their families and on their groups. There is a reluctance to completely give away stake. There is an instinct, an urge to sort of control, or say keep 20%, 25%, 30% of the stake while you are selling off the rest. And no one really wants to buy if the old promoter is still around. So it is going to be a lot trickier in India than it will be abroad.
Okay. Well, Krishnan, do you think that stress from commodity companies would lessen enough for you to improve your outlook on the financial sector, on banks?
Yeah, see, immediately I don't see the scope for that happening. But as I said, there are these positive developments of recent times which we are looking into. If I look at the banking sector asset side, we are still seeing a very high proportion of weak assets, and our projection still is looking at that increasing till March 2017. So we are looking at what we call as the weak assets in the banking system going to around 9% of 8.9 to 9% of the total asset book. We have not seen a reduction in that percentage so far, because the way we are looking at things is, if I look at the entire commodity space or the investment linked space, we are still seeing stress there. Debt levels are high, and we are not seeing cohesive or constructive means or sustainable means to reduce that threat of debt.
Mr. Rao, do you think that before this year is out, some weak steel companies will pass on into slightly stronger hands in India?
No, there is a big gap in the actual valuation which one perceives and the perception the existing managements and also the bankers have. There is a big gap. Unless that gap is bridged, taking into account the future outlook of steel industry in general and India in particular, I think then only any activity can happen. Otherwise, I don't think
but look at the composite picture. If you looked at the composite picture, the Reserve Bank has been forcing banks to recognize bad loans. There is public pressure from courts, from government, from the media that defaulters have to be punished. So there is a pressure and arm twisting that's coming from the ecosystem. That coupled with the fact that prospects look a little better, can they ensure something will happen in FY17 in terms of M&A activity?
We have to wait and watch. It's very difficult to say that it will happen or not. But today, whatever interactions we are seeing in the marketplace, there is a gap in the expectation of the valuations. So therefore, I don't think still it is ripe to have any big M&A activity in the steel sector in India.
Okay. Well, a final question to you then, Neelkanth. You all have become overweight on the material space, on the metal space. When might this pass on to financials? You have upgraded one bank, ICICI. When might you extend it to more finance companies?
See, for financials in general, and so you have to appreciate that model portfolio weights are relative weights. And so there are sectors which are faster growing. So if your credit growth is going to be 12, 13%, 14% at most, I mean, there are segments and sectors where we think growth can be faster. We are expecting that capital goods demand or other capex, private sector capex may not pick up that fast. We also don't think that the upcycle will last long enough for people to sustainably pay their debt.
Okay.
And therefore, we are sticking to the relatively high quality names even when we are playing the upcycle. So what is going to happen is that if there is let's say a broken steel company, I mean it may not be broken right now, but in markets views it is unviable. I mean debt per ton is $2,000. It's clearly unsustainable. The amount of that debt that needed to be written down was going out of the bank's profits, right? So the bank's book. Now that so the equity value is near zero anyway. The debt value had to be pared down. So the quantum by which that debt had to be pared down now falls, at least in the market's perception, for the next several quarters. Okay. And that adds to the bank's valuations, and that is the call we've made. Given that it is not, as I repeat, it is not a 3-year, 5-year bull run yet. I mean, one quarter at a time. So we are going to stay cautious on the good quality names. Going down the quality curve at this stage, I think, will be too risky for us.
All right, gentlemen, we'll leave it at that. Thank you very much for joining me. Since China holds the key to global and Indian steel prices, after this break, we will be joined by a steel expert all the way from Beijing, Kevin Bai of Crew Group.